In the tumultuous world of financial markets, few names resonate with the eerie accuracy of predictions like Michael Burry, whose legendary exploits were immortalized in the film The Big Short. With a penchant for making bold and sometimes shocking forecasts, Burry has demonstrated a unique talent for foreseeing financial tumults, earning him a place among the most revered investors of our time. This narrative embarks on a journey through Burry's most notable predictions, culminating in his latest prognostications for the global economy, offering insights into the potential impacts on financial markets worldwide. Michael Burry's storied journey began with a prophecy that seemed ludicrous to the established echelons of investment wisdom. In 2006, amidst a booming housing market, Burry foresaw a mortgage crisis that would cripple the United States, a prediction that was met with derision. Yet, by 2008, the financial world was engulfed in one of the most severe recessions in history, vindicating Burry's foresight and cementing his reputation as a visionary. Fast forward to February 2021, when inflation in the United States was a mere whisper under 2%, Burry forecasted a tidal wave of inflation that many dismissed as improbable. The subsequent inflationary surge, peaking in June 2021, and the dramatic downturns in both the stock and cryptocurrency markets later that year underscored the prescience of Burry's predictions. In September 2022, amid skepticism, Burry predicted a recession led by the missteps of top executives of the world's leading companies. The global economy soon felt the tremors of mass layoffs across major tech firms, further attesting to Burry's uncanny ability to anticipate financial upheavals. Burry's latest forecast, however, paints a somber picture of the future of the global economy and the financial markets. He posits that while inflation may have reached a peak, the cycle is far from over. According to Burry, we might witness a temporary decline in consumer price indices, possibly veering into negative territory in the latter half of 2023, with the United States inevitably slipping into recession. He anticipates that the Federal Reserve will begin to cut its balance sheet while the U.S. government injects stimulus into the economy, sparking another inflationary surge. Burry draws parallels between the current scenario and the inflationary cycles of the 1970s, a decade marked by a series of inflation peaks and troughs that ultimately required drastic measures by the Federal Reserve to stabilize the economy. He warns that we may be on the cusp of a similar cycle with potentially dire consequences for global financial markets. At the heart of Michael Burry's cautionary perspective is the intricate dilemma faced by the Federal Reserve and international regulatory authorities, ensnared in a relentless cycle of combating inflation through the implementation of elevated interest rates. This strategy, while initially effective, harbors the potential to unleash chaos across the global financial ecosystem, precipitating extensive downturns in markets worldwide. Burry draws a compelling parallel to the tumultuous epoch of the 1970s, a period characterized by fleeting triumphs over inflation, which, due to a premature relaxation of monetary policies, witnessed a fierce resurgence of inflationary pressures. This historical analogy serves as a stark reminder of the precarious balance that must be maintained to ensure economic stability. The specter of repeating past mistakes looms large, as contemporary efforts to quell inflation might inadvertently set the stage for its forceful comeback, thereby challenging the resilience of the global economy. Burry's insights underscore the complexities of monetary policy interventions and their profound implications for financial markets, urging caution and vigilance in navigating the uncertain waters of economic management. As we delve into Burry's analysis, it becomes clear that he sees a challenging road ahead for investors and policymakers alike. The Federal Reserve's current stance, as echoed by Chairman Jerome Powell, is to maintain a tight monetary policy to combat inflation. However, Burry posits that political pressure and economic strain may eventually force a shift towards lower interest rates and economic stimulation, potentially reigniting inflationary pressures. Michael Burry's prescient warnings compel us to meticulously consider the diverging trajectories that may unfold in response to the current economic quandary. On one hand, we face the prospect of the Federal Reserve yielding to the mounting pressures exerted by both the economic landscape and the political arena. This capitulation could manifest in the premature reduction of interest rates, a move fraught with the risk of inciting another surge in inflation. Such a development would not only undermine the efforts to stabilize the economy, but could also precipitate a cycle of financial instability reminiscent of past economic missteps. Conversely, the Federal Reserve might adopt an unwavering stance, maintaining elevated interest rates with the aim of decisively quelling inflationary pressures. While this approach harbors the promise of long-term economic stability, it portends a period marked by acute economic discomfort and heightened market turbulence. Investors and consumers alike would need to brace for a landscape characterized by constrained spending, slowed economic growth, and the potential for increased unemployment rates. This path, although arduous, could pave the way to a more stable economic foundation, free from the specter of runaway inflation, but at the cost of immediate economic pain and uncertainty. Navigating between these scenarios presents a formidable challenge, underscoring the delicate balance the Federal Reserve must strike in its quest to foster economic stability. As we delve deeper into this analysis, it becomes increasingly clear that the decisions made today will have profound implications for the economic health and financial well-being of future generations, making the path chosen a subject of paramount importance. In either scenario, Burry's prognosis offers little in the way of optimism for the near-term prospects of financial markets. His analysis suggests that conditions conducive to a new bull market, low inflation and low interest rates, are unlikely to materialize in the foreseeable future. This deep dive into Michael Burry's predictions reveals not just the potential economic challenges ahead, but also the intricate dance between monetary policy, market dynamics, and the broader economy. As investors and observers digest Burry's latest forecast, the debate over the accuracy of his predictions and the implications for global financial markets continues. In closing, as we ponder the complexities of the financial world through the lens of Michael Burry's forecasts, it's clear that the path ahead is fraught with uncertainty. The potential for significant economic repercussions looms large, underscoring the importance of vigilance and adaptability in navigating the ever-changing financial landscape. As we reflect on Burry's insights, let us engage in thoughtful discussion and prepare for the challenges and opportunities that lie ahead, always mindful of the lessons from the past and the possibilities of the future. Don't forget to leave your like and subscribe to our channel so you don't miss our next videos.